And risk aversion is what you may think of when it comes to retirement savings. Conventional wisdom says you should invest more conservatively as you get older by increasing your bond holdings. But there are some who say you should actually do the opposite. Joining us to talk about this is Smathers. He is the Managing Director and Financial Advisors at Shorebridge Wealth Management. Welcome. Nice to have you here.
My pleasure. Thank you.
Are you one who recommends you do the opposite, or are you more in the you need to remain kind of nimble and flexible camp?
I'm in the flexible camp. I think with today's interest rate environment at 40-year low yields, the traditional thought process of how you asset allocate has to change. And in retirement, it's very difficult today to have a significant allocation to bonds like the old days, perhaps 40 years ago, and be able to attain all of your objectives.
Yeah, I mean, that was at a time when interest rates obviously were much higher, but there were fewer products that you could garner income from. There are so many exchange-traded funds and mutual funds and other things that can provide you with some income in addition to growth, right?
Well, that's true. I mean, certainly the product menu has expanded greatly in the last 20 years in particular, but in traditional asset allocation, you want to have your safe assets being the fixed income part of the portfolio. How you do that could be with ETFs, mutual funds, individual bonds. But the old days, again, when you used to have 50, 60, 70% fixed income in a portfolio, you really can't achieve your goals anymore and do that to derive the income you need as well as to fight inflation. So as a result, the equity component of a portfolio is more significant today.
And how do you handle that? Obviously, every individual investor is different, but if you do increase your equity position, do you end up trading a little bit more? In other words, when you have a significant gain in a position, do you exit that position and bank the cash? How would you deal with portfolio management?
Well, traditionally, we start with an asset allocation, a split between stocks and bonds, for example. The stock portfolio is the growth vehicle, how we're trying to really exceed the rate of inflation and grow the portfolio principal. The bond portfolio, we try to buy very secure, safe bonds. The bond portfolio plays a role in our case of being an airbag, so that when the stock market falls, which it inevitably will do, we have a reservoir of safe money to rebalance our portfolios.
Okay.
Yeah, and the other way that we think about fixed income, and this really resonates with our clients, is that when we do our allocation, we consider maybe 8 to 10 years worth of their income needs in their bond portfolio.
Right.
So that way, when the stock. Oh, I'm sorry.
That's okay. When we have to run. Thank you so much, Smathers with Shorebridge Wealth Management.
Thank you very much.